get into that when we get over to 465, the market seems to not like that because we become Icarus, right? We start flying a little too close to the sun, and we start to feel it. So then,
all right, welcome back to the Intelligent Investment Show, the newly trademarked Intelligent Investment Show. The show itself, not necessarily trademarked, but Matt Dahl, my esteemed partner in crime here, has some exciting news on that. You trademarked Intelligent Investment and a whole bunch of other things. You trademarked the bull and the bear. That was exciting news. So congrats, dude.
Thank you very much. We've been working on it for a long, long time. The ARPG, the script, the bull and the bear, we've named them, of course. That's Roscoe and Otis.
Roscoe and who?
Roscoe and Otis, right?
Nice.
Roscoe.
Which one's Roscoe?
Roscoe's the bull. Otis is the bear. Right. You know, on our main homepage on our website, it says intelligent approach focused on you. Okay. That has also been trademarked. And those three were kind of easy to get. We never tried those before, but we submitted them and they went right through. The one that I tried 2 other times and couldn't get, I went to a different firm this time and we made a better case for it, was Intelligent Investment. And we now own Intelligent Investment as trademarked. It's ours. For investment advice, investment management, financial advisors, all that for that whole sector is ours. So when you're watching the Intelligent Investment Show, it's a trademark logo. It's ours. So
that's awesome stuff. So I don't know if compliance will let us leave this in the recording, but I did joke with you before. You literally own Intelligent Investment. Nobody else in the industry owns Intelligent Investment like Matt Dahl and ARPG on Intelligent Investment. So
yes,
if compliance lets that fly.
We do like our double entendres here, don't we?
That's right. Well, welcome back. So we've got a little bit of an odd schedule here because we did our live event last week, which I thought went, I don't want to say surprisingly well. I expected it to go well, but I thought it went really well, and you've had some good feedback from clients, so that's exciting. And we're not going to be able to record next week, so we did an off sequence recording here. Happy Valentine's Day to you. I hope you have big plans tonight for you and the wife, and you didn't forget that it was Valentine's Day.
Absolutely not. I bought her a bottle of my favorite scotch.
Not. That's a smart man right there. So I had a side story here, probably not relevant to most of our audience, but I had a situation one time in college where there was a relationship that I wasn't sure was going to last till Valentine's Day, but Valentine's Day was looming, so I needed to make sure that I had gifts just in case. So I ended up buying up like 2 or 3 or 4 gifts. The relationship did not last until Valentine's Day, and I ended up giving those gifts to the next 3 girls that I dated because I had them, and there's no reason to let them go to waste. So the next 3 girls that I dated, I had that covered. So always think ahead and be prepared.
I mean, listen. Falling in love, sometimes you have to buy in bulk.
Yeah, and now I'm almost 40 and single, so we can see how that strategy really works out long term. That might have been more of a day trading strategy. It worked well for a minute, but probably not the best thing for the long run.
Is it a long term investment or is it just a day trade?
There you go, man. Well, it's been an eventful week since our live show last week. So I know you had a lot of things yesterday. You were throwing out inflation and CPI and more movement in yields. So what's going on in the wide world of Matt Dahl since we last spoke on February 7th?
Well, it's definitely been a week. Yields spiked this week, obviously due to CPI that came out on Wednesday. Came in at 0.45 core month over month on a 0.3 consensus, right? And it came in 0.45. So it posted officially at 0.4. Okay. But how they round it is if it comes in at 0.46 and higher, it's going to show as 0.5. So had it come in at 0.46 instead of 0.45, 1/100th of 1 point, it would have posted 0.5. And I think yields would have actually gone higher than they did, which caused a little bit of consternation in the equities. But I got to tell you, this market has absolutely been nothing but cast iron underwear. I mean, whatever you throw at it bounces right off. Okay. Same thing with the DeepSeek from 2 weeks ago, and then obviously we had the hot CPI report. Okay, we had the Trump tariffs that Monday, right? All of these different sort of gap down and come back, gap down and come back. And this is the third time where We had a hot CPI and came right back. And now, as of yesterday, the 13th, we actually got a breakout. We got an official breakout. We saw the market kind of really start to break through this 2-month consolidation. It's been in since late November. It was basically 6,100 late November, early December, and here we are. We're finally back there. And we saw, and in that, here's the interesting part is, last time the market was about where it is now, we had yields at 4.15, and here we are at 4.45. Okay, but we went as, it broke out yesterday at basically 4.55. So the equity side is actually dealing with a significantly higher yield than it was 2 months ago, but it's still growing. And I think that is in large part due to what we talked about, that earnings need to pull their weight. They absolutely have. They have been rock stars this year. 77% has reported so far this quarter. 78% are beating by an average of 7.2%, which is pretty high. Normally we get kind of that 71, 72, 73% beat by kind of that 5.5% to 6.5% range. This is actually quite a bit better. So we're seeing year-over-year growth of 17.2%. Okay, that's significant. Okay, and I think that's why the market is really, is really optimistic about what the future is going to hold. And I think a lot of it has to do with, obviously, potentially maybe Trump. He's pro-business, low regulations. Obviously, tax cuts are just now starting to be sort of parsed through and announced. So the market, specifically the equity side, earnings are going to get the benefit of the doubt more so than they probably have these last few years.
Is there a floor that if rates go below, that's going to be a concern also, or would that just have to come from some type of economic problem that is creating its own issues for equities that's not related directly to interest rates?
Well, we have to discern where the rates are coming down on that yield curve and why they're coming down, right? Are the rates coming down because the Fed believes on the policy side, which is that short end of the curve? Is that part of the curve coming down because, obviously that's more sensitive to inflation and those pressures. So inflation's coming down, so that short end of the curve starts to come down, which then brings back, and we've talked about this multiple times, which sort of will bring down those mortgage rates. And will bring back that healthy 1.75% spread between the 10-year Treasury note and the 30-year fixed mortgages. Or is it something to do where the whole curve just slams down because there's an economic slowing, an exogenous event like COVID, okay, something like that. And typically what we like to see when there's no external event or there's no massive collapse in economic data like labor or something like that, we like to see that, kind of be above 3 as we look through the 10-year. So, and when you look at the multiple of the S&P 500, it lives in its highest zone on average when the 10-year is between 3 and 5%. Okay, when you get above that, right, that's when we get that yield issue, right? Where now we have 5% on the 10-year, right? That's got a 20 times multiple. So it's really hard for the equity side to go above that number. Okay. However, if it drops below 3%, well, now we've got some. That's usually due to economics that are slowing significantly, and there might have to be accommodation in the future. And that's the bond market usually getting ahead of the Fed and saying, okay, there's economic cooling happening here. Interest rates don't need to be this high because we're not going to have any sort of inflation is going to be fairly muted for the next few years due to the economy not accelerating, growing like it should be. And obviously that's when you have slower economics, you have slower earnings growth, you have less commerce happening. So you're going to have less earnings and earnings growth taking place. And that can also drive the multiple down. So we like that sweet spot. We like it, above 3, but we don't like it, obviously above 5. We're kind of at the upper end of the range here, right? 4.46 today. Okay. When we get into that when we get over to like 465, the market seems to not like that because now we're starting to get, a bumpy gravel road. Now we're getting a little too close we become Icarus, right? We start flying a little too close to the sun and we start to feel it. So then Obviously, the bond market, I think, does a good job of recognizing that. And if there's not something overly, overly dramatic taking over economically, endogenously or exogenously, then those yields tend to come back into play. So, back to this range that we're living in right now, and it's a pretty wide range, and it's a pretty long time frame in that range. I think we've got on the upper end, 475. You could probably go as high as 5 if you wanted to. Okay, and on the lower end, 350. You could probably go down to 325 if you wanted to. Okay, but that's basically the range we're going to live in, and I think that's going to be large in part due to, again, we've got these great tailwinds coming from demographics. We have just a huge millennial population entering their peak income and spending years, and they're doing a heck of a job making money and spending it. You know what I mean? So that's good. That's good, and we're seeing this. We're seeing this in in the CPI report. And I mean, if you look at CPI, I mean, of the 45, the CPI came in at 0.45. 0.17 of that, nearly 40% of that was shelter. Okay. So autos, which is auto insurance, used cars, and lease cars, that made up 0.18, which was 40% of that. So you have basically 80% of the inflation this month was made up of shelter and autos. That's it. Okay. So this is where I think we're going to see a pretty big gap between our PCE number that comes out next week and versus the CPI that we just had. And I think that's what equity markets are doing, yesterday and today, is they're pricing in a cool PCE that we're going to get. Consensus is 0.3. Remember, PCE, it removes those imputed prices like asset prices, right? Like if the market goes up and management fees will go up for accounts and things like that, or interest costs go up as yields go up, right? Those are imputed prices. The other thing PCE does is it parses out consumer behavior, like consumer substitution, right? And basically, with what grew this month in CPI, there was a lot of areas in CPI that really collapsed, right? Apparel being one of them, actually, airlines being one of them. So we're going to see a lot of, I think, as people how they spend their money. My guess is that's going to come in 0.3 or 0.2. Okay, could come in a little cooler than I think people are giving it credit for. And when that happens, I think we could see a potential rollover in yields, which the equity markets would really like.
You kind of did a little Tom Cruise Maverick flyby there of a couple of topics that I think I'd like to maybe dig in a little bit more on, the tariffs and tax cuts and things that Trump's now got, 3 weeks? It's Valentine's Day 2025. He's been in about, almost not quite a month, 3 weeks. What has you've always got this, what we think he's going to do versus what he actually does aspect of everything. Not just with Trump, but the market, what we think the market's going to do versus what it actually does. But what has changed concretely since he came in, and what does that mean to the markets? So, we were talking about tariffs, we were talking about tax cuts, we talked about a lot of different things he could do. What has he done, and how does that change outlooks for the market?
Well, he delayed the tariffs, right? Canada and Mexico have agreed to bring troops to the borders to prevent the influx of fentanyl into the United States, which prevented the tariffs from being implemented immediately. That was big. Okay. And then now he announced instead of I'm going to tariff you X, he's going to look at reciprocal tariffs. Okay. And what that communicated to the world, he also had a really good meeting with Prime Minister Modi of India yesterday. Okay. Where they agreed to like $500 billion in trade. Okay. So what he is communicating to the markets and the global economies is he doesn't want tariffs. He never did. Okay. He just doesn't want other countries to charge us tariffs. So if we're going to send a car to Japan or Europe, okay, and there's a 35% tariff on that, okay. If you send a car here, there's going to be a 35% tariff on it. If that goes down to 10%, ours will be 10%. And he's communicating in a way that's letting them know that I don't want to charge you tariffs, but I don't want you to charge me tariffs either. I want this to be a level playing field, and I think it's quite effective. I think he's he's holding himself out as a deal maker and somebody who wants free trade, but true free trade. It has to be good for the United States. If it's not good for the United States, well, then he's not going to participate.
Well, if you think about it there, I mean, we've still got this interconnectedness, right, of the global economy. This isn't the old Wild Wild West where everything can be, we're not as walled off from one another. What's good for one country is often good for many other countries and its trading partners and whatnot. So while us adding a tariff may give us a relative advantage or at least erase a relative disadvantage, the other country lowering tariffs so that we don't have to do that to level the playing field just kind of makes the playing field easier for both sides and all of its trading partners as well, right? So doesn't that kind of create a better outcome all the way around than just us slapping a tariff on that's going to hopefully levelize things from our side?
Well, I think yes. I'm going to be honest, yes and no. Yes,
I mean, we might be trending into water that's over our head, Matt. This is economics, not stock market. So I don't know for sure. If you ever need to punt, you just say the safe word, and we won't go there. You know what I mean? But
well, I mean, the little I do know about this, I'll do my best to share it. I think it's the answer is yes and no, but mostly yes for the United States. Okay, here's why, and we've touched on this before. Is I think the other countries, and I'm not saying that every product that we make in the United States is superior to every other product that's made all over the world in other countries. There's great car makers, there's great appliance makers, there's great phone makers all over the world. Okay, but U.S. products are very high quality and they're pretty ubiquitous, right? Especially in the United States, and if the U.S. products are on the shelf at a lower price point than they currently are, closer to the domestic product, that will cause that's again back to PCE and CPI, right? Now we have consumer substitution behavior happening because now those products are cheaper, okay? And the other thing that's going to happen is, so we're going to sell more of them, okay? Because they're going to be purchased more at a lower price. But the other thing is, and the actual point of sales places, the point of sales distribution outlets for these products, they're going to say, well, hey, that margins or that tariff is gone now. I'm going to be able to get a bigger margin on this. Okay. So they might lower price a little bit, but take on more margin. Okay. Which will be good for them. Okay. So it does lift all boats. It really, really does. But I think especially for the U.S. because again, now if there's tariffs that are coming in from the imports that the products that we're currently importing, right, that are tariffed, if those go away, now our point of sales to our distribution outlets can say, okay, well, now those prices can be lowered, which would be good for inflation, which would be good for interest rates. Okay, but also those businesses that sell those products can also take on more margin, right, which will be good for their earnings, which will be good for the economy.
And what about on the tax cut side? Has he announced what exactly he's going to do with corporate tax cuts? Is that taking effect yet?
I just started reading on that the other day, and it's $4.5, I want to say $1 trillion in tax cuts over the next 10 years. It's pretty significant. But I've not done a deep enough dive and to kind of parse out and figure out where they're getting that money from. Or how that's going to look. So, and of course, it's going to be debated robustly when it's actually announced. But I think it just got to the House a couple of days ago. So my guess is if I know Trump, he knows. I mean, he knows he's not going to get all of it. Okay, he's going to get most of it, and it's going to go through the House, and then it's going to get sanitized in the Senate.
Gotcha. I saw a really funny little meme or something on Facebook or one of the social gram things a couple of days ago. It was, the scene from Wolf of Wall Street where the dad comes in and is just like, shouting at everybody over how much money they spent at dinners and what their American Express bill or whatever was. Do you remember that scene? Have you seen Wolf of Wall Street? Surely, yeah.
Yeah, you got the credit card bill that month, and it was like
$400,000
or something.
Yeah, and they had like 28,000 on one dinner and all these different things. So there was a scene, there was a meme of that scene and comparing it to Elon Musk and Department of Government Efficiency and going through. And I've seen a few other serious clips of Congress talking about some of the things that they found. Have you heard or read any updates on what he has seen or what the update is on that side? Because that was one of the most compelling ideas that I had heard in a while. We talked about it a few shows ago, but just the idea of just cleaning up wasteful government spending and what that can do, obviously domestically for us.
Yeah, I mean, I've heard of millions of dollars spent on operas in Ireland and South America and through the USAID program. And there was something recently released, I think it was yesterday, the day before, in regards to a massive, massive fraud that has taken place through Medicare. Okay, and they're just now starting to find out. I don't know it yet. I've not read anything about it, and a lot of it's just coming out. I'm Mike, and I think they're going to start announcing some of these big findings that they have. But what I do know is so far they've been able to save $1 billion a day, $1 billion a day in government efficiency just since they've started. And their goal, and that's $365 billion. That's 18% of the deficit. Okay, so by the end of this year, or Elon's goal is to get to $3 billion a day, basically $1 trillion. Okay, and that represents 50% of the deficit. Okay, so if we get 50% of the deficit cut, and that I think that would be really, really helpful, specifically as it relates to the markets and the fixed income markets and bond auctions. If bond auctions go down, I think that would be, they obviously they wouldn't have to advertise or provide such high yields because there wouldn't be the volume of bonds available to cover the deficit side. And I think that's I think that's going to be helpful because again, not that we're a political show, but the math is starting to get tricky when it comes to our debt. Our debt is now the interest on our debt is $900 billion a year. Okay, so it's basically 19% of our budget, of our annual budget, goes to pay the interest on our debt. Okay, and back in finance classes and things, typically when that number gets at 17 to 20% range, when it goes above that, it becomes very, very. It almost starts to snowball on itself, and you become insolvent, right? Because then you just can't ever pay it. So I think we're at this again, kind of an inflection point where if we don't do something immediately and drastic, it's going to snowball, and this thing could really get really, really, really. Not that it's already not. It's gotten completely away from everyone. We know that, but really get away from everybody. And the next, we don't want to be paying 12% for our mortgage rates because we have such huge debt, and obviously the Treasury's having to release bonds at massive, massive high yields in order to attract any buyers. So, that I think is, and it's just been nothing but 50% of our deficit in just waste, in just pure waste. So maybe they can find the other 50% from other things. I'm not exactly, let's hope they can.
Well, here's the thing about that too. I mean, I know that time has. First of all, I'm getting a lot older than I used to be, so I guess it's longer ago than I was thinking. But when you said $900 billion in interest, and you're saying that Musk so far has found $365 billion a year in savings, I'm thinking the entire TARP bailout in 2008. That had everybody just freaking out about how much money we had to spend to save the banks. The entire TARP bailout was like, $750 billion? So, yeah, I mean, so we now are paying more in interest per year than we paid to save the financial system in 2008 from another Great Depression. Now, yes, there's inflation. Yes, that was almost 20 years ago. I get all that side. But still, those are massive numbers. And sometimes it's easier for me to take things back down to the household level, right? Like if you're struggling, a deficit just means how much more we're spending than we're bringing in a tax receipt. You have to bridge that gap somewhere, either by raising taxes, not just tax rates, but actually receiving more revenue from taxes, or you have to cut spending. When you start talking about cutting spending, and I don't want it to seem insensitive to certain projects, there's certain things that, yes, government needs to spend money on to take care of its citizens, to protect its citizens, to support citizens, and even supporting other countries in some situations. I get that too. But when you're just like government spending that is an investment towards something that is going to increase overall economic, if you're investing in a road project that's going to improve travel and infrastructure and all these different things to help the economy run smoothly, then that's great, because you're going to, maybe you spend $1 billion on it, but it creates $2 billion more in tax receipts over the next 10 years. Well, that's a smart investment long term. But when you start spending money on stupid things, like, what did you say a few shows ago, studying the sex life of the African tsetse fly or whatever, I don't even know if that's a real thing, but there's a lot of things like that.
I hope it is.
Yeah. When you start just burning money and not doing something efficient with it, it's just sucking money out of the economy that could be used elsewhere for something better that was positive for economic growth. And again, it's not to seem insensitive to. It doesn't mean that every single dollar we spend necessarily has to have a positive economic return on it. Sometimes there is just goodwill and taking care of people and protecting citizens and defense and all these different things. But when you just start burning it for no reason, that's not good long term, and especially as we're knocking right up against that ceiling of where economics class says it can become a tipping point.
Well, I think a great example of just that is if you look at the NATO spending, right? And what the United States has provided Europe for so many years. Right? They provided this shield of defense against, obviously, Russia and the Soviet Union for a better part of 70, 80 years now. And the NATO treaty says 2% of GDP goes to NATO. 2% of all NATO countries, 2% of your GDP goes to NATO. Okay. And that's to fund NATO, to fund the defense of the common defense, right? Well, the United States has more than fulfilled its obligation, more than 2%, okay, for years and years and years. Whereas many other countries, most of the countries, not all of the countries, but most of the countries have paid little to nothing into those countries. Okay. Now, these are European countries. These are countries like Denmark. These are countries like Poland and whatever. Okay. Well, a lot of those countries also enjoy free healthcare and free college and all kinds of social services. Big unemployment benefits if you lose your job. There's all kinds of those are socialist countries, right? Those European countries with a big social net under them, right? Well, they were able to provide that because they weren't spending their money on defense. We were paying for their defense. So it wasn't those countries putting those kids through a free college or giving their senior citizens free health care and giving them housing and helping them with unemployment. They weren't paying for that. The United States was paying for that because the United States was overpaying for their defense and they weren't paying anything. So I think that is what is being unwound, and that is to your point, as far as that's not a good investment, okay? Because I think Trump is just saying, listen, I would much rather put the kids in inner city Chicago, Detroit, Houston, LA. I want to put those kids through college, and if I'm spending a bigger part of our GDP on defending countries that won't spend any money to protect themselves, hey, time out. We're not doing that anymore. Okay, we're paying all this interest on this debt, and I want to use this money more effectively for the citizens of the United States, and that's what he's looking to do. So and something has to be done because we have been basically the bank and the force and the defense and the breadbasket of the world for so long. It's time for I think the rest of the world to start pulling their weight.
Yeah. So what we got coming up? You said earnings are about 75% of the way through. Any big earnings reports coming up in the next week or two? Any big data that's coming out that investors need to keep an eye on?
Yes, NVIDIA is due to report next week.
So, NVIDIA, the big boy.
The big one. NVIDIA is due to report next week. I want to say they're looking for 82 cents a share. So my guess is they're just going to light that thing on fire. They're going to post 90 cents a share, $1 a share, and give us massive guidance. This whole DeepSeek thing, I think, is kind of run its course. It appears that DeepSeek, although innovative, it's limited, right? It uses an old type of chip where basically it looks at half the data and it decides what's irrelevant and it removes it, then looks at the next half and decides what's relevant. And that's how it figures things out. That's a very old chip. I learned that system in Computer Science 101 at UNLV here in Las Vegas in 1996. Okay? It's like how they find your account number, right? If you're one of them, tens of millions of account numbers, right? The computer doesn't go all the way through and then find yours. It picks an account, it knows your account number. It just goes into the pool of account number, grabs one and says higher or lower. And then it disregards it. Okay, higher. So it disregards everything lower. It does 10 or 12 little quick transactions and it finds you. That's how those systems typically work. And I'm pulling this from nearly 30 years ago from college.
Oh,
so
wow, big brain.
If I get that wrong, I'm sorry to all the computer nerds that know way more than I do because I'm not a computer guy. Okay, so that's from what I was able to gather. That's sort of how the DeepSeek chips work. So, therefore, some of the readings that we've done is what you saw with DeepSeek. Although it does work, that's what you're going to get. It's limited. Like you can't do more than what it's already doing. Okay, and it can't do a lot of the higher and so what they call the higher bandwidth memory, the HBM. It doesn't have the high bandwidth memory that obviously the NVIDIA Blackwell chips, the AMD chips have. So it's not going to really grow. It won't service those higher end AI needs or Gen AI or super Gen AI needs that obviously are coming in the future. But what it did do, I think, was it showed the world that there is another solution, an affordable solution. Because if I remember right, it was Dan Ives at Wedbush who announced the DeepSeek, and I want to say it was announced at it cost them $5.3 million or $5.8 million to build a DeepSeek. I mean, that's not a rounding error for NVIDIA. I mean, that's an office lunch for NVIDIA. Yeah. They take their people to dinner and it's $5.3 million. So, and I think what that's going to do is it's going to put some pricing pressure on the lower end. What we might see now is sort of a bifurcation of AI, where we have your upper end AI, your Blackwell chips, and those things that can do everything and anything. They're going to grow and snowball. But there's going to be another use for AI, which is maybe an effective use. Maybe it's not the best of the best, where you would use it in a military or a flat hour space, but it's a lot cheaper. Remember the old iPhones, like the iPhone, it was called the SC or something. It was a cheaper version of it, and it didn't really take off. But I think that's what we're gonna come into. We're gonna see a more affordable version of AI for smaller companies, people that want to use it, or almost like a free version where the community can use something like that. I don't know. It could be anything, but and that's why we've seen NVIDIA recover. In fact, on that DeepSeek Monday, I got a communication from a client saying, hey, what do you think about this DeepSeek thing? And I said, sounds like typical China nonsense to me. Looks like a really good buying opportunity for NVIDIA. And of course it was. It's not Blackwell. It can't do what the NVIDIA chips or the NVIDIA chips can do. And it was a good buying opportunity for NVIDIA on that day. So, and that again, that's when you have to parse out, okay, is this headline risk? How long is this going to last? Is this really going to affect the earnings of NVIDIA 3 years from now? Unlikely. In fact, I think it could actually help NVIDIA because now there's a whole other, I'm sure you have to understand those folks at NVIDIA, they're not stupid. Okay. They're really smart. They just went, oh, so you're telling me there's this whole other market that now wants our stuff for basically stuff that we already have? Yeah. So we can build AI chips now with stuff we already have, and half the world will, okay, let's do that.
Cool. Good idea.
You know, how does that hurt them? I don't know. I think it's okay. But, I mean, we had like, I think, I just think, there's always this fire ready aim. The market doesn't react. The market only overreacts. And of course it overreacted, but sometimes it does what it's supposed to do. Like this week, obviously it overreacted to CPI, but it came right back. This morning we had retail sales come in minus 0.82 month over month retail sales on a 0.35 estimate. So it missed by 1.2%. Okay. That's a huge miss. So yields rolled over a little bit, market took off. So we're sort of in this like good news, bad news now, right? We're looking for a little bit of cooling here and there in the markets. Things are going to bring yields down a little bit. We're looking for good numbers, but not great numbers.
Yeah.
Everyone thinks the Fed is on hold. I'm not there yet. I think they're on hold, but not permanently. I think they're on hold for the next 2 meetings, probably 3 meetings. But again, they are keenly aware that they are restrictive. Okay. And if PCE comes in cool, and we finished year over year PCE for February, obviously for January, okay, at 2.6, and we're at 4.5 on the upper bound, again, we're 190 basis points of restriction built in. That's a lot. And it's only a matter of time before that really starts to feed in and starts to cause problems. And I don't know that the retail sales number isn't, and the PCE number won't reflect that, because remember, PCE reflects that consumer substitution behavior. So, in fact, I was talking to one of my advisors who works for me, and he obviously, he's doing quite a bit better now than he was 5 years ago. Okay. So I said, well, here's a good idea. Here's a good example of what consumer substitution behavior. Let's say you made exactly the same money 5 years ago that you make today. I said, how much home could you have purchased 5 years ago? Right? Much, much more. So you're now having to substitute for a smaller home. And I saw a little figure a couple of weeks ago, and it talked about a house. Maybe it was 4 years ago. It was a $400,000 house. The house was $400,000, and the interest was 2.93%. Okay, that same house is now worth $550,000, and the mortgage rate is 7%. So what was a $1,760 payment is now a $3,450 to $3,500 payment. Okay, so it's double. It's double the payment, and that's sort of where you see CPI will say, okay, prices and interest have gone up tremendously. Whereas PC said, well, yeah, but that person now is having to buy less home to make up for it. So that's where we're going to start to see the cooling. And I really believe in the competence and the foresight of this Fed. And I know they're going to get. They've done a great job, and I think they're going to continue to do that. And they're very, very, very sensitive to any changes, especially negative changes in labor. Okay, PCE. I think the reason it's their preferred measure of inflation is that's going to lead labor, because that tells you how people are spending their money. If they're spending their money not so great, if that's starting to tighten up, well, that's letting you know that money's getting tight. And the next thing is, okay, well, our business is not making the money. Are they going to start laying people off? And it starts to snowball. And again, they're keenly aware of that. I'm sure they're going to want to make sure they kind of sidestep that.
Cool stuff, man. Well, we are on a 21-day break, I guess, now. So it'll be a little bit before we see you again. But so let's see. We'll be I'll get this in here. So we'll be back on March 7th. Is that right?
That sounds right.
Yeah. So we're on a 21-day break. We will see everyone back here March 7th for our next installment of the Intelligent Investment Show. Matt, thank you as always. And I'll get these other disclosures in there also, but I'll say it my own way too. The Intelligent Investment Show is for entertainment, education, and general amusement purposes only. Neither Matt nor I know anything about your financial situation, so please do not take anything either of us say as investment advice and act upon it without talking to a financial advisor. If you would like to speak to Matt, he may be reached at, I don't have your number in front of me again right now, so 702-655-8300. Did I get it right?
You nailed it.
All right. I always used to say 8200. I got it right there. 702-655.
They can always go to intelligentinvestment.com.
There you go. That's the trademarked intelligentinvestment.com.
The newly trademarked. I'm going to guard that jealously.
I hear you, man. I would too. I love the name. All right, man. We'll have a great, prosperous weekend. Have a good Valentine's Day.
Yes.
Take care of your
wife.
Happy
Valentine's Day to you.
What's that?
Happy Valentine's Day.
As always, the Intelligent Investment Show is for your entertainment, education, and general amusement purposes only. It is not intended to be financial advice or investment advice of any kind. Neither Matt nor I or any of our companies or associated entities know anything about your financial circumstances, so it would be unwise for us to tell you what to do with your money. We encourage you to seek a professional if you do have questions about your portfolio or your financial plans. If you would like to reach Matt and his team, you may do so by giving him a call at 702-655-8300 or visiting intelligentinvestment.com. We thank you for joining us. We'll see you next time. Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG, and United Planners are independent companies. Garrett Layell and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.